Please stay tuned for important disclosure information at the conclusion of this episode.
Welcome to the Investing Insights podcast from Morningstar. The Morningstar Investment Conference for investment professionals will be held virtually this year on September 16th and 17th. We're offering the same research, analysis, and insight for investment professionals you'd get at the live event for a reduced price of $149. And the best part is you can join us from wherever you are. For more information or to register, visit go.morningstar.com/MIC. In this week's podcast, we share which utility stock we added to our list of high conviction picks for August. Russ Kinnel uncovers which funds had the biggest outflows. Christine Benz discusses early retirement during a pandemic. Maria Bruno explores where people can find extra cash. And Russ Kinnel shares the top funds for income seekers. Let's get started. We share which utility stock we added to our list of high conviction picks for August.
In early August, Morningstar's equity analysts updated their list of high conviction picks. One of the stocks added to the list was First Energy. First Energy shares declined more than 30% following the arrest of the Ohio House Speaker and 4 others on racketeering charges, although no executives of the utility have been charged. The criminal complaint refers to a Company A, which is clearly First Energy, and its current and past affiliates as a source of most of the funds used in the alleged bribery for the passage of Ohio House Bill 6 in August 2019. The event is a public relations nightmare, and regulatory and political relationships in Ohio will be strained for several years. Nevertheless, First Energy's underlying businesses are solid. Its 3 Ohio distribution utilities represent less than 20% of operating earnings, and base rates are fixed until May 2024. As the bribery headlines fade and the economic impact of COVID-19 dissipates, we estimate compound annual earnings per share growth of 6.4%. In our opinion, dividend growth in line with earnings expansion should be the catalyst for the market valuing First Energy shares in line with our $44 fair value estimate.
6 days a week, we deliver the latest news for investors. Just say, Alexa, enable the Morningstar skill, or visit morningstar.com/Alexa.
Now, Christine Benz and Russ Kinnel from Morningstar Inc. uncover which funds had the biggest outflows.
Hi, I'm Christine Benz from Morningstar. Which funds are investors throwing overboard? Joining me to discuss some of the funds with the biggest outflows of assets year to date is Russ Kinnel. He's Morningstar's Director of Manager Research. Russ, thank you so much for being here.
Glad to join you.
Russ, let's talk about flows year to date. We have seen pretty significant flows into bond funds, I believe, but there have been some bond funds that have been seeing outflows. So let's start there. PIMCO Income has seen sizable outflows year to date after experiencing pretty strong inflows for the better part of the past decade. What's going on there?
That's right. PIMCO Income is a silver-rated fund, so obviously we like it. But it's had about $10 billion in outflows in the first half. And what's really going on there is that the fund's got, it's fairly aggressive, and it's got some non-government mortgages, which have been great performers for a very long stretch, but not this year because of concerns about the economy, obviously. And so it's had a stretch of rough returns this year. But its long-term record is still good, and obviously we think very highly of. I think you just have to recognize this is a fairly aggressive fund. So if you understand that, you should be okay.
And I think that it's important to kind of think about where you place it in your portfolio, right? That if it's your mortgage payment or next year's tuition payment, it's probably too risky for that.
Oh, for sure. I think it's a pretty aggressive bond fund. I think if you're thinking about something you're going to tap for cash in a year or two, you want something like a short-term bond fund with high quality or a money market. I think this is much more like, as you're building out a very wide-ranging income portfolio, this is one of your more aggressive options.
Okay, good to know. Templeton Global Bond, that one I believe has been in redemptions for a little while now. Let's talk about that fund and what is driving investors to continue to hit the exits there.
This is Michael Hasenstab's fund, a manager we really like, but it's had about $6 billion in outflows, and I can understand why, because it's got a big emerging markets bias, which has hurt its 3 and 5 year returns. But we still like its long-term prospects. We rate it gold. We think Hasan Saab's a very good investor, but you can see when macro calls go wrong, even at the best of funds, it can hurt performance.
Okay. Double line total return is here. This had been a real darling for investors for many years, but they seem to be pulling assets recently. Why do you think that is?
Oh, yeah, it's had about $5 billion in outflows in the first half. And a little similar to PIMCO Income, although maybe it's had even more non-agency mortgages. So that's led to mediocre to poor 1, 3, and 5 year performance. So I think to a degree, this is a fund that had done so well. Maybe people had unrealistic expectations, and now it's come back to earth a bit. But we rate it bronze, at least some of the share classes. So we still think it's a pretty good fund.
Okay. And the last one is First Eagle Global. The first 3 were all bond funds. This is an equity, mainly equity fund. Let's talk about why investors seem to be retreating from this one.
Yeah, so we've been talking about some aggressive funds that had a difficult year. This is a fund that's supposed to be very conservative, that's supposed to protect against losses through an array of measures by value stocks, by gold, some fixed income. But it's actually year-to-date losses has been pretty disappointing. And so I think investors were kind of unhappy with it in the bull market because it was falling behind, but now it's underperformed a bit. Not dramatically, but I think given expectations, that's still pretty disappointing. And so I think that's why people are leaving it. Now, we still have it rated bronze. We still think it's got some good characteristics, but it has been disappointing. And part of that is simply that value has underperformed growth. But even beyond that, I think it's a little bit disappointing.
Well, I wanted to ask about that, Russ, because I think in the last financial crisis, we saw that as well, where value didn't necessarily save investors. So should investors not sort of overly rely on funds with value and orientations to save them in these periodic equity corrections?
No, I think value does have some greater economic sensitivity than growth. And so that's why these last 2 bear markets, which happened at the same time as recession, that value has gotten hurt. I think maybe being diversified value to growth and obviously having some fixed income is probably more important. A fund like this does try to be defensive, but obviously we can see from this year that those have real limits.
Okay, Russ, it's always great to get your insights. Thank you so much for being here.
You're welcome.
Thanks for watching. I'm Christine Benz for Morningstar.
Watch all the Morningstar content you love from your living room. Download the Morningstar Roku channel and get up-to-date independent insights on today's markets. Be comfortable. Be informed.
Next, Susan Jabinski and Christine Benz from Morningstar Inc. discuss early retirement during a pandemic.
Hi, I'm Susan Jabinski with Morningstar. The pandemic may be leading some people to think about retirement a little bit earlier than they expected. Here with me today to explore the topic is Christine Benz. Christine is Morningstar's Director of Personal Finance.
Susan, it's great to be here.
So what are you seeing in terms of what impact the pandemic might be having on people deciding to sort of pull that trigger a little earlier than they might have expected and retiring early?
It's interesting. Mark Miller, who's a contributor to Morningstar.com, has been monitoring the employment situation for older adults. And one thing we saw in the last financial crisis is that older adults hung on to their jobs at higher rates than younger adults. So people 55 and over managed to lose their jobs at a lower rate than the rest of the population. This current situation appears to be different, where we have seen the older cohort, so again, people 55 and above, lose their jobs at a higher rate than the younger age bands. The youngest age bands, so like people under age 35, they still are the hardest hit in the current pandemic, but we are seeing higher rates of unemployment among older adults as well. So I think that this is an area to watch closely, especially given that this economic crisis is also a health crisis. where you may have some older adults, especially those who have pre-existing health conditions or other things that might make them concerned about being out there if their jobs require them to be physically in the community. They may be mulling early retirement. So I think we may see more people contemplating retirement either by choice or because they have had some sort of displacement as a result of the current crisis.
So given that we're seeing, higher unemployment this time among that cohort that is closer to retirement, are you suggesting that they should consider looking for work, or should they be considering retirement? Sort of, what's your take?
Well, I think it's up to each individual, obviously, to make health decisions, do what's best for their health first and foremost. But when you look at all of the research that's been done over the years about what helps people sustain themselves, sustain their finances throughout retirement, you see that the benefit of continuing to work longer can be incredibly beneficial. So not only do you keep earning a paycheck, but you have fewer years that you are drawing down upon the portfolio. Delayed Social Security filing can be immensely helpful. Continued contributions to retirement plans, additional tax-deferred compounding, all of those things add up to continuing to work in some fashion, maybe not in the most remunerative position that you could possibly have, but in some fashion, all of those factors do add up in terms of improving a portfolio's sustainability.
So for those who might be mulling an earlier than expected retirement, what are the key factors or key considerations that they should be, taking into account right now?
Well, one of the key things I would say, Susan, is get some help, because as much as I would love retirement planning to be more simple, one thing you see is that there's so many moving parts, and we all come into retirement with our own toolkits, our own situations, our own set of types of accounts that we have. And so I do think that this is a great spot to stop and get some help from a financial advisor. You needn't necessarily sign on for a long-running engagement, but you can pay advisors on a sort of per engagement basis or an hourly basis if you so choose. Get some help before proceeding further. That's my first and main piece of advice in this space.
Now, if someone wanted to maybe even just get a ballpark of whether this is feasible, and if they find it might be feasible, they might want to seek the help of an advisor. How could they go about doing that back of the envelope?
Yeah, I think that you absolutely should do that back of the envelope type of calculation. Even if you hire an advisor, you should be on board and understand the different variables in your plan. So I would really break it down into three key parts. So you want to think about forecasting your spending needs. How much are you going to need? And ideally do this on a year-by-year basis. And I see retirees getting quite specific, which is great, where they're actually forecasting, okay, in 5 years, we think our roof is going to need to be replaced. In 2 years, we're going to need to replace one of our cars. And so on down the line, where you're really specific. You're not just using today's spending to determine whether how your spending needs will change. Also factor in healthcare costs. That's a huge variable, especially for people who are pre-65, pre-Medicare age, who may have to shoulder some of the healthcare insurance costs because they're no longer covered by the employer plan. That's definitely top of mind for many retirees today. So that's the first step, just getting your arms around how your spending might change. The next step is to look at what your non-portfolio sources of income might be in retirement. So for many of us, that'll be Social Security. For some of us, that might be a pension. Other people might have income sources like rental income. So you want to tally those up. Again, look at those on a year-by-year basis. The benefits of delaying Social Security, if you possibly cannot be denied. But tally those up and see how much of those income needs will be supplied by those non-portfolio sources of income. So then you can subtract out your non-portfolio sources of income from your spending needs, and the amount that's left over is basically the amount that you'll need to draw upon from your portfolio. And there's certainly been a lot of work done on what is a sustainable starting withdrawal rate. How would that sustainable starting withdrawal change over time, potentially to incorporate changes in your spending, to incorporate inflation, to incorporate fluctuations in the market. So that would be sort of the 3-step back of the envelope process that I would take, just to make sure that you understand the moving parts of retiring early and making sure that whatever plan you've created is sustainable.
Well, Christine, thank you for your time today. A lot of great advice. A big part of that being seek professional advice on such a big, life-changing decision.
Absolutely. Thank you, Susan.
Good to see you. Thanks for being with us today. I'm Susan Jabinski with Morningstar.com. Thanks for tuning in.
Now, Christine Benz interviews Maria Bruno from Vanguard.
Hi, I'm Christine Benz from Morningstar. Amid the pandemic and its related economic effects, some individuals may find themselves in a cash crunch. Joining me to discuss some strategies to consider if you're in this predicament is Maria Bruno. She's head of U.S. Wealth Planning Research at Vanguard, and she's also a certified financial planner. Maria, thank you so much for being here.
Thanks for having me, Christine.
So Maria, we always counsel people to have that emergency fund in place. Some people may have exhausted their emergency funds if they've faced unemployment through this period, but that really is the gold standard, right?
Yeah, absolutely. I mean, we talk about emergency savings a lot, and I think a lot of individuals are kind of going through that crunch right now. So we talk about the rainy day fund, an emergency savings fund of typically 3 to 6 months worth of living expenses in some type of cash account. I think that's a good starting point. I don't think it's for everyone. What we often suggest, and we've written some research around this, is really to rethink emergency savings. And by that, I mean, think about it in terms of spending shocks versus income shocks. So spending shocks tend to be those things that maybe something goes on the house or the car. It's an unexpected expense that you need to make sure that you have ample funds for. We usually give a guideline of having about a half month worth of expenses, maybe up to 3 months, in a cash type account. By that I mean either a bank checking account, savings account, or like a money market mutual fund where you can have quick access to that. Beyond that, you may want to think about an income shock, which is exactly, having some type of loss of job and the impact there. And there you maybe want to think about other types of vehicles. One of the things I like to talk about is if you have a Roth IRA, you can access the contributions income tax-free and penalty-free. You've talked about this as well, a multitasking type account. So it's a retirement account, but yet it does have a liquidity feature that is there in the event that you would want to use that. Another thing to consider will be health savings accounts. So if you have medical care expenses, if you have money in those accounts, those are there to meet those expenses. Ideally, if you can pay out of pocket, that's the best thing to do because then the account continues to grow tax advantaged. But health savings accounts obviously are one way to meet healthcare expenses. And then the other thing I would add there is brokerage type accounts. So if you have non-retirement accounts, think of those as well. But be mindful if you need to tap those to be as tax efficient as you can be when you go and make any transactions. Maybe look for any types of losses or try to minimize gains on those types of accounts.
So let's discuss the CARES Act with respect to emergency funding needs. It did open up some additional opportunities for people who want to potentially tap into their retirement assets. So let's talk about those withdrawals that might be available. Shouldn't be a first line defense, but might be available for some people.
Right. So they did provide some relief for individuals who are impacted by the coronavirus. So they're able to access their employer-sponsored plan or their IRA up to $100,000. So pre-59.5, if you tapped these proceeds, you were subject to a 10% early withdrawal penalty. So that's been waived, and you can take the distribution up to $100,000. And then you also have the option to spread out the tax liability over 3 years. It's important to note that the early withdrawal penalty has been waived, but the actual taxation with the distribution still holds, but they allow the taxes to be paid over 3 years. So that is one option. I will note with that too is if you take the monies out and you return it within that period, then you wouldn't necessarily have to pay the taxes. So there is some flexibility there if you're in a pinch to access that type of funding. The other thing that was part of the CARES Act was the ability, a little bit of an expansion on 401k loans. So now the limit is up to, it's the lesser of $100,000 or your vested balance, and you have up to 5 years to repay that loan. So those were two of the expansions on the ability to access retirement accounts.
So that's what you can do under the CARES Act. I guess the question is, people might be grappling with, should I do this? Can you address that?
That's a good question, just because the option is there, whether you should take advantage of it or not is highly individualized. So I would probably suggest stop and thinking through this a bit too, just to make sure that you understand the implications of that. If you do pull from your retirement accounts, particularly if you're taking a withdrawal, you're subjecting the withdrawal to income taxes. So that's another liability there as well. But you're also taking the distribution from the retirement account and foregoing compounding all those dollars. So it may not seem like a lot. A simple example, you could take a $10,000 withdrawal from a 401k, for instance, and you assume hypothetically a 6% annual return. Over 30 years, that comes to $57,000. So what seems like a small amount of money today, the loss of compounding actually has greater impact over time. So I would suggest a couple considerations there before tapping those monies to see whether or not you have other liquid assets or other accounts like Roth contributions that you might want to consider tapping before tapping the 401k. That said, if you're weighing those types of distributions against, high interest credit cards, you might want to look at that type of option as opposed to incurring additional debt with high consumer interest rates.
You mentioned HSA assets, Maria, and you mentioned kind of the thesis where if someone has healthcare expenses, those are great assets to tap on an ongoing basis if you need them to defray those healthcare costs. How about the HSA if you have been using it as kind of a savings vehicle and you have other non-medical expenses? There's some flexibility there, right?
Yeah, it's interesting. So, there's many benefits to health savings accounts. You've talked and written about this as well in terms of the tax benefits, and there's lots of flexibility with these types of accounts. So you can really treat them as a retirement vehicle. And, depending upon the investment options, invest accordingly. If you're in a good position where you have the financial means to pay healthcare expenses out of pocket when you incur those and let the HSA grow deferred, that's terrific. What you can also do is if you do incur those healthcare costs, sometimes we call it shoeboxing receipts, where you then can go back and, if you have these receipts, you can match them up to the HSA and then you withdraw from those accounts later. And obviously you're not using it to fund that specific healthcare cost because you incurred that, potentially years before. Right. So I guess the point there is that the healthcare cost doesn't necessarily have to be incurred in that year. There's not necessarily a matching, but you can actually pay out of pocket. And then later, if you would want to then go back and use that receipt and pull from the HSA, essentially, you have that flexibility.
Okay, Maria. Big topic, lots of people grappling with some of these considerations. Thank you so much for being here today to provide your insights.
Thank you, Christine.
Thanks for watching. I'm Christine Benz from Morningstar.
And lastly, Christine Benz and Russ Kinnel share the top funds for income seekers.
Hi, I'm Christine Benz from Morningstar. Among thousands of mutual funds, how can investors go about identifying the ones that are worthwhile? Joining me to share 4 income-friendly funds is Russ Kinnel. He's Morningstar's Manager Research Director. Russ, thank you so much for being here.
Glad to be here.
So Russ, every year you take a look at the Fantastic 40. It moves around a little bit, but you run a screen where you take the broad fund universe and you look at funds on a number of different variables and you actually get it down to a fairly short, manageable list. This year it's how many? 36 funds?
It's 36 funds, yes.
Okay, so you've got 36 funds. Let's talk about the screens that you put in and use to arrive at this shorter, more manageable list.
Sure. Well, the idea is that there's 8,000 funds out there, but really only a few data points that are particularly vital in selecting the best funds. So instead of having a lot of screens, the idea is just have a few screens, but really be stringent with each one of them. And a small number of funds comes out. Sometimes it's in the 30s, sometimes it's in the 40s, but it's just 6 core screens is all that I'm doing to get that list.
Okay, so expenses I know are top of mind. What other things do you look at?
That's right. So cheapest quintile expense ratio, manager investment over $1 million, parent rating of above average or high, medalist rating, so bronze or better, and risk cannot be, Morningstar risk cannot be high. The idea is that high Morningstar risk, people tend to have a harder time making good use of higher risk, more volatile funds. So we'll screen out just the high risk funds.
Okay, so in general, the idea with all of the criteria that you put in there, you're looking for better investor outcomes. You're looking for things that we have found are correlated with better performance.
Exactly. Manager investment is correlated with better performance. Low fees are correlated with better performance. Our analyst rating, we think is correlated with better performance. Still, to a degree, you could say the jury's still out on that one. But yeah, that's the basic idea.
Okay, so you brought a short list of funds that cleared all of the hurdles for 2020, and the funds that we're going to talk about today all do have some sort of an income focus, which I think is an interesting thrust to discuss, especially given how low yields are today. So the idea is that you brought a group of funds that you think have a sane approach to delivering investors income. Let's start with a fund that has been a longtime favorite among our Morningstar.com readers and viewers. That's Vanguard Wellesley Income. It looks good and made it through your screens.
Oh yeah, of course it ticks all the right boxes. Vanguard, a great parent, super low fees, great track record. It's a fund has to have beaten its benchmark over the manager's tenure. So really, just does a great job on so many fronts. The idea is they have 65% fixed income, 35% in equities. And the equities are also expected to generate a dividend. It's led by Michael Reckmeyer of Wellington. And obviously just a really great steady Eddie fund. You just look at that year on year consistently, pretty good returns, pretty good yield. And of course, when you have fees as low as you get from a Vanguard fund, you don't have to stretch for yield. A manager with a fund that's charging 1 or 1.5% is going to have to take on a lot of risk just to get even with this fund, which is so cheap.
Okay. Next fund on your list that cleared the screens is American Funds American Mutual. Let's talk about that one.
Yeah, we mentioned Wellington, who's good at investing in dividend stocks. Capital Group American Funds, this is also in their wheelhouse. They're just very good at finding good companies that pay a good yield. So they want, the target for this fund is to have a yield above the S&P 500, but they don't want to do so with a lot of risk. So they look for healthy companies as well. And you can see that versus some other equity income funds, this one doesn't have a huge weighting in energy or utilities. You can see the consistent performance that even in a year like this year where a lot of higher yielding stocks got punished because there was a lot of credit risk there, this fund is just a very smooth sailor, lost much less than its peer group. So really a strong gold-rated fund.
Okay. Switching over to fixed income funds, Fidelity Total Bond made your list. Let's talk about that fund, Russ, and I'd like to hear how it performed during the first quarter, which was such a great stress test for bond funds.
Sure. So this one's run by Fort O'Neill. It's in our intermediate core plus fund category, which means these are a little more aggressive than the the typical core fund. So what that means is you're going to have more credit risk. In particular, this fund has a 20% budget for high yield and emerging markets. So it can be aggressive, but it is, like you see a lot of Fidelity funds, it's very focused on issue selection, on quantitative research. And so the fund lost about in line with peers in the downturn, but is actually doing pretty well for the year to date. So I think pretty respectable. The fund's kind of managed nicely, and when it has high yield weightings and when it doesn't, and that really shown through this year as well as over the long term.
Okay, and its name notwithstanding, it's not an index fund. It sounds like it could be, but it's not.
That's right. It's actually an active fund with more risk than a total bond stock or total bond market index fund would have.
Okay, and then Dodge & Cox Global Bond is also on your list. We also like Dodge & Cox Income Fund, but let's talk about the Global Bond Fund.
Yeah, our first three funds were kind of old timers. This one's only been around for 6 years, and because I require manager tenure of at least 5 years, it's only recently become eligible. But I really like this fund. Dodge & Cox is really a company researcher, and so you see that reflected in the portfolio. It's about half corporate bonds, which is really unusual for a world bond fund. Most of those funds really love sovereign risk. They're betting on countries. Here they're betting on individual securities because that's what Dodge & Cox does so well. They've got great analysts who are really good at researching the whole capital structure of a fund of a company, and you see that in the performance. It's really good, and it's still a small fund, under $1 billion. But what's great about Dodge & Cox is they charge a low fee from the beginning. So this fund charges 45 basis points. You don't have to wait for it to be massive to get a good value on the expense ratio.
Okay. Russ, thank you so much for being here.
You're welcome.
Thanks for watching. I'm Christine Benz for Morningstar.com.
That does it for this week's Investing Insights podcast from Morningstar. We hope you have enjoyed our program, and we welcome your feedback. Please send your comments and questions to podcast@morningstar.com. From everyone here at Morningstar, thanks for listening.
This recording is for informational purposes only and should not be considered investment advice. Opinions expressed are as of the date of recording. Such opinions are subject to change. The views and opinions of guests on this program are not necessarily those of Morningstar Inc. and its affiliates. Morningstar and its affiliates are not affiliated with this guest or his or her business affiliates unless otherwise stated. Morningstar does not guarantee the accuracy or the completeness of the data presented herein. The podcast is for informational purposes only and should not be considered tax advice. Please consult a tax and/or financial professional for advice specific to your individual circumstances. Morningstar Research Services, LLC is a subsidiary of Morningstar Inc. and is registered with and governed by the U.S. Securities and Exchange Commission. Morningstar Research Services shall not be responsible for any trading decisions, damages, or other losses resulting from or related to the information, data analysis, or opinions or their use. Past performance is not a guarantee of future results. All investments are subject to investment risk, including possible loss of principal. Individuals should seriously consider if an investment is suitable for them by referencing their own financial position, investment objectives, and risk profile before making any investment decision.